Financial Reporting Through the Lens of a Property Casualty Actuary. Chapter 19, Part 9. The RBC Charge for Basic Operational Risk. The Basic Operational Risk Charge considers the risk of financial loss resulting from operational events that have not already been reflected in existing risk charges. This includes the inadequacy or failure of internal systems, personnel, procedures, or controls, and external events. Additionally, this accounts for legal risk, excluding reputational risk from strategic decisions. The operational risk charge uses a percentage or add-on charge of 3% applied to the total RBC after covariance before basic operational risk. The operational risk charge is further reduced by the sum of offset amounts reported by directly owned life insurance company subsidiaries that prepare and file the life RBC calculation, adjusted for the percentage of ownership in the directly owned life insurance company subsidiaries, but not to produce a charge that is less than 0. Table 97 illustrates the final calculation of NAIC RBC, including basic operational risk, for fictitious. The RBC Model Act. Each state's statutes define a minimum amount of capital that a company must have to obtain a license in that state. These amounts vary by state and by lines of business, but are usually relatively low, from $1 million to $5 million. These minimum capital amounts do not account for the characteristics and risk level of individual insurance companies. The purpose of RBC is to help regulators identify insurers that are in financial trouble and that need regulatory attention. Therefore, the RBC requirements attempt to individualize the minimum capital requirement for each insurer. RBC is not a target level of capital that insurers should hold. Rather, it computes a minimum level of capital adequacy that a company must have to operate. The RBC requirement is a dollar amount calculated from the NAIC RBC formula. The RBC that results from the formula, total RBC after covariance including basic operational risk, is compared to a company's total adjusted capital. Total adjusted capital is equal to the company's policyholder surplus from page 3 of the annual statement that is reduced by 1. The amount of non-tabular discount from Schedule P Part 1 summary, columns 32 and 33, and 2. Tabular discount on medical reserves included in Schedule P Part 1 summary, column 24. Additionally, a property casualty insurer that owns a life insurance company subsidiary adjusts its surplus for the same amounts as the life subsidiary does for RBC purposes, namely by adding back the asset valuation reserve and 50% of the dividend liability to surplus. All such affiliate amounts are adjusted by the company's percentage of ownership. The RBC ratio is the name used in the insurance industry to describe the ratio of total adjusted capital to authorized control level, or ACL. While discretionary, ACL is the point at which the insurance commissioner is authorized to take control over the company under the RBC Model Act. ACL is equal to 50% of the total RBC after covariance, including basic operational risk. RBC ratio equals the total adjusted capital divided by the ACL, which equals the total adjusted capital divided by the quantity, the total RBC after covariance, including basic operational risk, times 0.5. Regulatory action is permitted when total adjusted capital is within 50 percentage points of the ACL, i.e. when the RBC ratio is 150% or less. This is called the regulatory action level. Table 98 summarizes the level of regulatory control relative to the percentage of total adjusted capital to both the RBC and ACL benchmarks. As noted earlier, the detailed calculations of a company's risk charges are not available to the public. However, 2 metrics of RBC are disclosed in the 5-year historical data exhibit of the annual statement: total adjusted capital and the ACL. A company's RBC ratio can be calculated by dividing the total adjusted capital by the ACL from the company's 5-year historical data. Table 99 provides the RBC ratios for fictitious from its 2018 5-year historical data exhibit. As displayed in Table 99, the company's RBC ratios have been well over 300 points above the company action level, the first action level within the RBC framework, which ranges from 150% to 200% of ACL. Note how the 2018 ACL amount of $5,588,000 is 50% of the total RBC after covariance, including basic operational risk, shown in Table 97. As shown in the actuarial opinion summary in the appendix of this publication, fictitious insurance companies' range of reasonable reserve estimates is $43 million to $57 million, with an actuarial central estimate of $50 million and carried reserves of $51.557 million. If the high end of the range was to materialize, total adjusted capital would decrease by $5.443 million, which is $57 million minus $51.557 million. At $25.581 million, the total adjusted capital would still be well above the company action level of $11.45 million by $14.131 million. Some appointed actuaries look to the impact on capital resulting from a movement in reserves relative to the high end of the actuarial range for purposes of selecting a materiality standard. See Chapter 16, Statement of Actuarial Opinion, in their Statement of Actuarial Opinion. According to the NAIC 2018 RBC instructions, 98.5% of property casualty insurance companies usually fall within RBC levels that require no regulatory action, i.e., having total adjusted capital in excess of 200% of ACL. However, just because a company's RBC results do not require regulatory attention does not necessarily mean that the company is strong financially. RBC is intended to be one of a number of tools used by regulators to evaluate financial solvency and therefore should not be used in isolation. Trend test. Companies with RBC ratios exceeding 200% are not necessarily free from regulatory attention. Companies with an RBC ratio of between 200% and 300% are subject to the trend test. The trend test serves as an early warning sign to state insurance regulators of companies that may be on a path to reporting an RBC ratio below 200%, thereby triggering the company action level. The trend test looks to see whether companies with an RBC ratio of between 200 and 300% also have a current year combined ratio that exceeds 120%. Companies meeting the trend test criteria are required to comply with the company action level requirements, despite having an RBC ratio in excess of 200%. The combined ratio is calculated as the sum of 1. The loss and LAE ratio, 2. The dividend ratio, 3. The expense ratio. The loss and LAE ratio is calculated as calendar year net incurred loss and LAE divided by net earned premium from the statement of income. The dividend ratio is equal to policyholders' dividends divided by net earned premium from the statement of income. The expense ratio is equal to other underwriting expenses incurred plus aggregate write-ins for underwriting deductions from the statement of income divided by net written premiums from the underwriting and investment exhibit. The future of RBC. Since its inception, the RBC model has continued to evolve, and this chapter has captured the details of the calculation at a point in time. In particular, over the past decade, the RBC formula has had substantial development as a consequence of the comprehensive review of the solvency framework in the U.S., performed as part of the NAIC's Solvency Modernization Initiative. Such changes included the addition of new catastrophe risk and operational risk charges, as well as enhancements made to various existing risk categories, such as investments in affiliates and reinsurance credit risk. In the future, the principles behind the RBC calculation are unlikely to change substantially, although we are likely to see continued enhancements to the calculation to reflect evolving practices in the measurement and management of risk. One initiative currently undertaken by the NAIC is the development of a group capital calculation that will provide regulators with another regulatory tool to understand the level of risk across an entire insurance group, i.e., aggregating across all of its operations to complement the RBC requirements that are applicable at the legal entity level. The RBC calculation is likely to also remain a key component of an insurance company's annual Own Risk and Solvency Assessment, ORSA. First introduced in 2015, the ORSA is an internal process undertaken by an insurer to assess the adequacy of its risk management and current and prospective solvency positions under normal and severe stress scenarios.